let me just start off by asking you what you make of all of this questioning vis-a-vis the Fed's next steps, when they're going to cut, the dialing back of expectations, only for them to be ramped up again based on, one data print of CPI. Is there too much volatility around the Fed's rate cut expectations?
Yeah, I mean, the volatility is obviously being caused by the data. If you think about the start of this year, when the Fed was signaling that they wanted to start cutting interest rates, the markets had 6 to 7 rate cuts priced in for this year. But in the first quarter of this year, the inflation data didn't go in that direction. That caused the markets to scale back their expectations. We've had a better report in April on the CPI numbers that have helped the markets reprice in rate cuts. But it's difficult for central bankers. They keep on telling us they want to be data dependent, but that obviously then causes the volatility that we're seeing now in the markets as the data swings around.
Do you get the sense that the Fed are perhaps more highly sensitive to inflation downside surprises than potential inflationary risks? Is there an asymmetry in terms of the Fed's response to the data that's coming in?
I mean, I think that's the criticism that Dr. Rajagan just made there, where he's obviously saying, look, the Fed shouldn't be speaking so much about rate cuts now because the data isn't there to justify that. And he's probably right at this stage. What the markets are looking for is not just the next few months, but the next 6 to 12 months. If you think about the longer term outlook, it is likely that the Fed is going to be cutting interest rates. The Fed do need to signal that, even if it's not going to be imminent. The problem for the Fed is that the data isn't giving them what they call greater confidence to signal rate cuts yet. And so the markets keep on chopping and changing between strong data to weak data, back to strong data.
What do you think the market would like to see in terms of not just the timing of the first rate cut, but how many subsequent rate cuts happen afterwards? If it's one and done, obviously that would be a disappointment, I would think. But what do you think that sweet spot is?
I mean, markets obviously like rate cuts, so the markets would like to see as many rate cuts as possible. I think the key point here is that in the interim, we do need to see the inflation numbers moderating. So you said earlier about the PC numbers that are coming up on Friday. So the markets are hoping that the rise in core PC prices moderates to about, say, 0.2 to 0.3% a month. If we get down to that range over the next few months, then the Fed can signal that it's willing to start cutting interest rates. If the numbers continue to slow down, then the Fed can start cutting, say, at least once a quarter, not every meeting, but once a quarter. So that's once every 2 meetings. That would definitely then encourage financial markets. You'd see stocks rally again, you see bond yields come down, you see commodity prices increase. But that probably a quarterly pace of rate cuts is a sweet spot that investors would like at the moment.
Yeah, interesting. Let me ask you if you have a view on where 10-year yields could go. And I just wonder if the Fed do start cutting interest rates, alongside that, the market has to believe that they've got a firm grip on inflation. Because if the market doesn't believe that inflation is headed back to 2%, you could still see upward pressure on yields. Where do you stand on that debate?
That's absolutely right. So we do need to see the inflation data first moderate to allow the Fed to start embarking on a rate cutting cycle. We think that's going to happen. We've got 4 more inflation reports before the September FOMC. So as long as those inflation numbers get back into a range of showing core prices rising by 0.2 to 0.3% a month, rather than the 0.4% a month they have been averaging in the first quarter. So if the range of increases moderates, then we think the Fed can signal clearly that it's going to start cutting interest rates at the end of Q3. That would then allow 10-year yields to fall. At the moment, they're stuck in this range between 4.25 to 4.75%. Would expect that range to go down probably by at least 50 basis points. So then you'd see the markets pricing the 10-year yield between, say, 3.25% to 4.25%. And as long as the Fed can carry on cutting interest rates every other meeting, then, yeah, yields would be able to go through 4% back to the end of last year. So we think 10-year yields about 3.75% is a reasonable 12-month forecast.